So let's get to it. What I really want to do here is, my name is Chris Dowty. I'm the CEO of Sourcing Investments. We're a property investment platform. We've been operating for 7 years now, based here in the UK. We've also just launched in the USA as well. And really what we see is what is really going on the ground. There's a lot of commentary that we see from newspapers and all the rest of the sort of the news feeds and stuff like that. But what we can actually see is what is happening directly between investors and what is happening directly between agents. And that's something that no other platform can do. So what I really want to do is sort of give you a bit of an overview. It's not like complete gospel. It's obviously my thoughts and opinions, backed up with a bit of data as well. But just want to give you guys context, because I think at the moment everything is very doom and gloom, and bank interest rates and this and that. And really what we want to do is put things into a little bit of perspective. When is the right time to buy? And it's quite the same answer every single time. It doesn't matter whether it's 2007, it doesn't matter if it's 2011. The time to buy is now. The difference is what you're buying and what strategies you're using as a sophisticated investor. So UK house prices, just to give you in context, on average with 9.5% growth in 2022. The property market predictions seem to be varied and changing every single month, whether you're dealing with Jones Lang LaSalle or anybody other market opinion, they don't know. But at the same time, predictions are on average looking about 5 to 7% down between 2022 and 2024. These are sort of driven not necessarily through the actual demand for the properties themselves, but other market pressures such as inflation control measures, which are being implemented by the Bank of England, which is pretty much the only method of increasing interest rates in order to try and control inflation. And so with increasing interest rates, that's obviously making liquidity and lending in the market in order for a lot of people who use lending in order to acquire properties, which is becoming a little bit harder compared to sort of this time last year, where you were talking less than 2% for a residential mortgage. You're now looking at 4.5%, which for some people is unattainable and making it very restrictive for first-time buyers, for example. But on the flip side of that, rental prices are going up, which is obviously very good if you actually are in the landlord property game already. But at the same time, that does not mean that you cannot acquire and control property by coming into the market now, even if you're not an existing landlord. So the opportunities are there. You just need to use strategies in order to control, not necessarily acquire right now. So again, what I'm trying to point across here is become sophisticated. This is the difference in what I would call an average investor versus a sophisticated investor, utilizing strategies such as property lease options in order to secure options of prices for the property, and also taking the current rental, supply on those properties and on those portfolios, and also rent to rent. And I know that already in the little breakout groups, there's a few sources looking to do that. We actually, just to give you an idea, have noticed that very few do it well. So through Sourcing Investments, we actually now provide a complete package of insurance cover, which covers you for operating. So please come and check us out if you are a deal sourcer or looking to operate in that. Record high rents, again, and making it hard for first-time buyers, but obviously very good for landlords. So there's always swings and roundabouts in the market. We're just in another cycle. It's not new. It's happened before. And so this is nothing really to worry about. It's just understanding what is going on. It is a buyer's market now. Again, whether the buyers themselves are, if you're heavy cash rich, it's an unbelievable time for you. At the same time, with obviously using leverage, that's a little bit more sophisticated, but those rates are coming down, as Bruce has highlighted. And so that means that the confidence in the lender market is increasing, even though there is going to be potentially forecasted a slight increase in Bank of England base rate again. But again, the confidence is really, what's the word, stabilizing, now that we're not changing prime ministers every 5 minutes. So the key thing is shift your strategy, control the portfolio, control the property, and look to buy it later on. That is a strategy that is working very well now. And so again, with the market remaining cautious, but the opportunities are increasing. We are seeing that from all of our agents across the board. We currently have 92 at the moment, and they are shifting to more of a rent-to-rent and purchase lease option strategy. But there are still a lot of properties if you are just wanting to acquire those as individual units or portfolios. So one of the things is purchase lease options. These are 2 PIN courses, and I'm actually going to do, and Andy, I'm sure you've talked about it. There is the purchase lease options that are available through PIN. Please, if you don't understand what that is, go and learn how to do it properly. Do not try and cut and paste it from your mate. You will get into trouble. And secondly, sourcing masterclass, which I believe is later this month, Andy, if that's correct.
It is, yeah.
This is not necessarily just for agents, for all investors, and that's a lot of you out there on this call today. Go and learn how to find properties properly, and ones that you don't want but are still good deal. Then learn how to make that into a business and get other people to source, and more importantly, you source it for them. So learn how to find opportunities properly, and then learn how to actually then engineer that opportunity, whether it's acquisition or whether it's, you know, packaging up rent-to-rents for other investors. These 2 are very powerful to combine. So please have a look into those through PIN courses that are happening this month. This is one to give you an idea. This is one I went through last month, but it's still worth going through it. This was a portfolio of 8 properties. It's a 7-year purchase lease option generating just over 4 grand a month. The estimated value in 7 years was just shy of £1 million. There was no refurbishment required. And in year 1, just with the engineering of the deal and structuring of the deal, it was £40,000 to acquisition to control. That's a pretty good return on your money with regard to taking control of a portfolio. 280 people were interested on the platform, with 4 offers in 48 hours. This is a shift of the market of where it's going, and this is why you need to understand what these deals are. These are not, you know, for, I would say, amateurs. You have to know the risk that you're going into. Go and learn exactly what a purchase lease option is. And then when the time is right, in the next year or 2, you call up Bruce for the actual acquisition and funding of the acquisition. Another one, this was a 4-bedroom house, individual, not a portfolio. Again, the estimated value of it is 100 grand more in about 3 years. And more importantly, with a 9 grand per year profit, with an outlay of £28,000 to take control of this property, you have a 32% ROI. This is something you genuinely need to consider, and this is where a lot of our market is shifting towards. This, for example, as it was a sourcing fee, was £6,000 for any agents out there. If you find the good deals on stuff like this, the investors are more than happy to actually provide you with that service and the payment for that service. Right now, there's just shy of 150 deals on the platform. We now have 92 agents around the country. If there are any agents in this conversation now, in the chat room, etc., please come and give us a shout with regard to your compliance, with regard to actually getting access to 35,000 investors, both in the UK and globally. And there are off-market deals, discounts, rent-to-rents, and PLOs. Actions for you guys now. What do you want to do if you're an investor? Please come and take a look at this. You need to come in and register. There'll be a final, take your phone out, but the ladies are going to put it in the chat box right now. And also there's lots of other stuff. It's not just a platform. We have a deal clinic live, which actually shows live deals working with the agents. So if you're an agent, you can gain at least 250 viewers every month to come and have a look at your deals and get to know you, because this is still a people's business. That happens every month. And this is Bonnie, who looks after our ecosystem of sources. And then likewise, there's all kinds of opportunities. You can gain access to PIN globally. You can even see all of our power team members, of which Bruce is a key member here and actually joins Deal Clinic Live, don't you, Bruce? You love doing that. I know you do. And as I say, it's all about clicking, access, and accessibility and speed. And that's what we bring to you, the investor, and also you, the sources out there. As a final one, again, compliance. All of this stuff is integrated now. It's not a pain in the bum anymore. And we've now structured it with financing, so you can get it for as little as £149 a month. And we've had many sources who've come through the PIN Sourcer courses taking advantage of this, and it allows you to now go and run your business without having a massive pain and headache. And that includes all of your insurance to execute in the property game properly. So please come and have a look at us. There's the link, sourcinginvestments.co.uk, promo Simon PIN. If you're an agent, please go to the agent page, but hopefully this gives you a nice understanding of what's going on in the market, and really appreciate your time.
Great. Thank you so much, Chris. So there's another photo opportunity there then, an opportunity for you to scan the QR code, go and connect with Chris, and he'd be delighted to help and welcome you along there as well. Let's then start. and do our market analysis, because it's quite interesting, isn't it, what's happening in the marketplace right now. I'm going to stop sharing my slides for just a moment because I want to invite Bruce and Chris to come back, because the marketplace here in the UK certainly is seeing its ups and its downs, and there's lots of things going on here. And I want to get the take from our experts today to really help and inspire others along the way. If you've got a particular question about what they're saying, we may have time to do your questions. If you just put Q and then your question into the chat box, I will spot that and I will pick some of them. I may not be able to pick all of them. But I'd like to think about what's happening, because certainly in the news in the UK recently, we've noticed that in Europe, they've had some problems in their banking structure. They've had one or two banks, for example, Credit Suisse has been swallowed up by their biggest competitor because, well, they had a little bit of trouble, banking trouble. And I just want to see, is that going to be a problem for the UK market, and what the take on this is going to be? Let me first of all come to you on this one, Bruce. What's your thoughts on European banks, and do we need to worry about UK banks?
We're quite isolated from Europe now financially because of Brexit. If Brexit didn't happen, we would have been affected by this. But there's been, since the global crash in 2008, the banks are very, very well capitalized right now. So I'm not really that worried about Europe. I'm not really that worried about America, because we are quite insulated currently. So unless the ripple effect goes globally, I think we'll be fine.
And I think if savers sort of hold firm and don't have a panic, I think that's the reason why Northern Rock, in the sort of original banking crash, people wanted to take their money out. That caused, isn't it? It's like a domino effect, I think they call it.
Correct. And social media is not helping with runs on banks, and that's why one of the Silicon Valley Bank went down, because there was a WhatsApp group which just spread misinformation. They took all the money out of the bank, and they just went bust because of panic in the market.
What's your thoughts on it all, Chris? What do you think is going to be happening with regards to the European banks, one or two of them having a wobble?
I think with it, look, we always forget that, you know, we're human beings, and we make the same mistakes time and time again in cycles, and that's why, you know, we have economic cycles every sort of 7 to 10 years. And I think, you know, this is perhaps part and parcels that we suddenly think that this is new. We suddenly think that, you know, for whatever reason, that the cycle we're going through now, where interest rates have gone up, we've got instability in banks. You know, if you look at history in itself, and you look at, you know, going from, Black Friday, you know, going back into the 1930s in America and stuff like that, we are consistently overstretching ourselves. We get overconfident, and, you know, in our nature. The same with investors, with banks, etc. And then there's always got to be a correction. Does that make sense? And unfortunately now, where, you know, what you just said there, Bruce, with regard to sort of, unfortunately, communication and social media and misinformation, and where do we get the source of information from? And there's so many of them. Unfortunately, I think people are not necessarily thinking for themselves, but this is part and parcel. The fact of the matter is, and I definitely saw it, I've just been away and I'm not boasting, but been in Bali for 2 months. And saw a very different market compared to the UK. Here, it's very structured. We have a high demand for rental, for people just to live. We're not talking about tourists. We're not talking about anything like that. We have a very, very stable housing market compared to the rest of the world. You look at like what's going on in Europe, in Sweden, etc. You know, with like Stockholm, and I think I did it last month, if anybody was here, and just showing the different downward cycles that's going on at the moment, and corrections in like Stockholm and various other places around the world, compared to the UK, is much more unstable. And when I say unstable, it just means that you have this, you know, it's a bit like up in Scotland, you have, you know, I'm just trying to think, up in, not Inverness, but we're talking about certain towns that are related to the price of oil, right? So you go there and people go, oh, this is a great place to buy because the, you know, property prices have gone up 50% in the last sort of, you know, 3 years or whatever. But that's relative to how well the oil industry are doing. It's a very microclimate. Overall, the UK market is very stable. Yes, at the moment, it's not as sexy as it used to be with regard to interest rates being low and stuff like that. But at the same time, I think for anybody investing here, the opportunities are there. You have a high demand for these products, as in, you know, rooms, as in HMOs and whatever strategies you get into. And I think people need to, as I say, just sometimes step out of it, understand this is part of the cycle, and utilize different strategies in the moment. But ultimately, taking control of property, there's going to be a demand for either selling it or renting it from you. You just need to be able to be adaptable and not just be a one-trick pony as the markets change over a 7 to 10 year cycle.
And as you said in your talk there, Chris, of course, this is a perfect time for purchase lease options, rent to rents, and those kinds of things to acquire properties. It is very much a buyer's market. When the prices are coming down, it's not easy to sell properties, and people still need to sell, but they can't because people aren't normally buying. Whereas we as property investors, it's a perfect time for us if we know what we're doing. It's about educating yourselves on how to go make those things happen. Chris, you also mentioned earlier on there, this is probably a question for Bruce, but Chris, you mentioned about the Bank of England base rates and the markets sort of being a little bit fluid at the moment. And Bruce, coming over to you, the Bank of England has raised its base rate up to 4.25% right now. What effect is that going to have on the mortgages, if any?
A lot. I mean, trying to get 75% loan to value in the southeast is very, very difficult. Very difficult. And it used to be possible on a 5-year fix, but even now on a 5-year fix, because the Bank of England's moved up and the rate is now, fixed rate's now about 5%. I'm using the 5% as a stress rate, not the 3% where it was pre-COVID. And it's the southeast is going to, the market's going to stall more in the southeast, more than the Midlands and up north, because the yields are so much better up north. And I believe in 2023, you need to be chasing yields. If you're looking to buy property, you need to be trying to get a 7 or 8% yield on property, be it an HMO, be it a MUB, a multi-unit building, a semi-commercial property. I feel that is where people need to be investing because they've got to chase the yields.
And so what is the correlation then between those interest rates, the Bank of England base rate and the mortgage rate? So I appreciate that it's not so easy in the southeast, but around the country, I'm guessing that there seem some real balances, hasn't there, in where people can buy property?
Yeah. And even the southwest, Bristol, Devon, Exeter, it's very difficult to get 75%. You're only really looking to get 75% sort of Milton Keynes and north. And that's purely down to the yields, because the interest rate, the Bank of England's gone up, the rental stress test has gone up, therefore you can't get 75%. Therefore, people are looking at different areas to invest.
And I know you got a slide, haven't you, to share with us
Yes.
about interest rates and the effect it's been happening. If you'd like to share that now, please. I think we can get an awful lot from this, because it's the outlook for 2023.
This is what Lloyds Bank produced. It's a little snippet I've taken from it back in January, February this year. And first of all, it looks at interest rates. First of all, it looks at inflation, CPI. And the whole reason why Bank of England is going up is to try and calm down this built-in inflation. Now, as soon as the inflation starts coming down, interest rates should be coming down. Interest rates is a very blunt tool. It affects everybody. It's not precise. A lot of economists think it's outdated, but it's the only tool Bank of England's currently using. And what they're predicting, Lloyds is predicting, that by the middle of 2023, if you can see my arrow, the inflation rate's going to come down to about 5.5%. They then asked the economists, basically, what's the effect of interest rates keep going up on the effect of the interest rate coming down? Now, if Bank of England remained constant at 4%, they predicted the interest rate will come down on the red line. And if interest rates peaked at 4.5%, which most people think interest rates will peak at that, there is virtually no difference on the effect of inflation coming down. So what's knowing this prediction of the inflation coming down, what are people predicting what interest rates are going to do? And this is the graph which they produced. So you've got the Fed being the US, you've got Bank of England in green, and you've got the European Central Bank in red. So obviously we're seeing interest rates increase, and everyone's seeing that we may be at the top of our curve, and interest rates will start coming down Q3, Q4 this year. This is actually reflected in the swap rates. And we're seeing swap rates come down. Now, swap rate, if anybody doesn't know what a swap rate is what a bank buys money from another bank at. So they normally say, I'm going to buy 1 billion for 1 year. What interest rate are you going to charge me for that? Or I'm going to buy 1 billion at 2%. Sorry, for 2 years, what interest rate are you going to charge me at? And so on and so on. And you can use this to predict what the people who paid millions are going to say, what they think, what interest rate's going to do. Now, at the beginning of March, 1 year fixed rate money was 4.5%, and it's already down to 4.3% in the space of, I don't know, four weeks. 2 year money down from 4.4 down to 4%. You've got 3 year money, 4.3 down to 3.8%. And this is the key one, is the 5 year fixed rate money. 5 year swap rates are actually lower than the Bank of England currently. So that tells me interest rates are definitely coming down. And the good thing is for mortgage borrowers that the swap rate was 4% and lenders charge a margin on top of that. Now that rate is now down to 3.6. So I predict that these swap rates will come down lower by Q3, Q4, and the swap rates may be down to 3% by then. And the banks are charging a little margin. So 5 year money is going to be able to be used to get 75% on buy-to-let mortgages. So I think we're getting there, Andy. I think we're near, give it another quarter, and we're going to start seeing interest rates come down.
And I think if we can ride out then the rest of this year, then things should be getting brighter. Just one final thought then, if you're looking at that Bank of England base rates, of course, that means because there's a shortage of property, because of mortgage availability, it means that people have got to have no choice in renting. Shortage of property means rising rents. How sustainable is it for these rents to keep going up with regards to people? Obviously, great for the landlords, but of course, it's not if people now are not going to be renting your property. What do you think is going to happen with the affordability there, Bruce? Then we'll go over to Chris after.
I'm actually seeing a lot of people, a lot of landlords saying, I've got a lot of new HMO tenants coming to them. People who can't afford 1-bed studio flats, they can't afford the cost of living, and they're actually downsizing into HMOs, which is a fixed price. So I actually think this year, HMOs are going to be the big thing for landlords, and occupancy rates are going to be very high. It's still a very big barrier for people to get into the marketplace currently. So I think we're going to see a lot more of renting generations for a lot longer, because the bank of mum and dad has run dry, I believe.
What's your thoughts on it, Chris?
Well, in actual fact, funnily enough, I would say over the last, I've got a portfolio of HMOs focused actually on students down in Plymouth, which the yields are still pretty decent, Bruce, down in Plymouth. But what I was going to say was, in actual fact, the mindset has been changed around the HMO space. Well, I'm seeing that down in Plymouth anyway, where it used to be an all-in-one build solution. But with regard to utility prices going up, etc., and if you hadn't fixed it, probably a year ago or whatever, you are getting pain with regard to the price of gas, the price of electric, etc., which has really pinched a lot of landlords. And what we've actually seen now is a shift where those prices are now not going to be including bills included. And in actual fact, so naturally, by just holding on to the property, we're seeing next year already the prices for landlords, the net is actually significantly higher without even doing any increase in rent. So because now the actual onus is being put on the usage of the utilities, water, gas and electric, onto the tenants, which in actual fact, me from a selfish perspective, being a landlord, damn right should always happen, in my opinion, because unfortunately nobody really cares of leaving the lights on until they're actually, you know, hurting themselves in their pocket. But that's a psychological difference. But from my side, as I say, I think the demand is so high for HMOs, and I'm talking just simply from a student perspective, which is my demographic focus, and just really shows that at the end of the day, if you have a quality product, and I think that's the key, relative to the location of what you're trying to supply. So, for example, being close to university, you know, is paramount, because at the end of the day, your demographics don't want to walk 15 minutes to uni, right? So they want less. But what we're noticing is those rents are going up, not necessarily from a direct increase in rent from landlords, but in actual fact, the change of the expectation of bills are not going to be included anymore, because the landlords are not going to be taking that hit, especially what they've seen, or what I've had to take a hit on in the last sort of 6 months. But the key thing is, and this is what you said at the start, Bruce, the key thing is, when you are investing for the long term as an investor, cash flow is always king. Yield is always king. And it allows you to weather storms such as what has happened over the past sort of year, in that change of where everything was hunky-dory. And if you didn't have the right cash flow, you're going to be, suddenly it's going to be costing you to hold those assets. So when investing, always be looking at yield is the play, and everything else is a secondary bonus in capital uplift, unless you are buying and selling as a developer.
Fascinating. Thank you so much, Chris. Thank you to Bruce. Please help me thank my guests helping us with the market analysis here at the Global PIN meeting. Mark, I can see your question there in the chat box. What are the likely implications of the ongoing leasehold reforms, the opportunities emerging? The leasehold reforms are really going to stop the selling off of the freeholds, and I think there'll be something brought in such as common holds. That's what is being said on the street. Of course, we don't know the full implications of it all now. I think with regards to leases on houses, I think they'll become less and less. There's no advantage to having leasehold houses. The house builders were doing that in order to generate a lot more income. Leases will, of course, stay with flats, because, of course, you've got only a section of the whole building, not all of the building. And so I do see that leases will still be a popular thing with regards to flats. And there's a lot of money by way of title splitting that can still happen, just not the selling on of the freehold. The value of that will have gone. Those are the main consequences I can see, but we'll have to wait and see what they bring out in that reform. I hope that was a quick and sustainable answer for you there, Mark.